we're looking at bank earnings this morning. JPMorgan is kicking it off for Wall Street tomorrow. To find out what to look for, how these quarterly reports will play out in the stock market, we're joined by Jason Tyler. He's Senior Vice President of Portfolio Management at Ariel Investments. Jason joins us from Chicago this morning. Jason, it is always great to have you. Let me ask you this question. It's been quite an extraordinary year for some of these firms, JPMorgan, Goldman Sachs among them. In general, though, how important are these earnings reports going to be to investors like you?
This earnings season is, I think, going to be one of the most critical ones we've had in a long time. Frankly, a lot of investors think that we've peaked in terms of identifying problem credits, and the market's going to be looking for some evidence of that coming out in this earnings season.
Now, what's your opinion, though? Do you feel like we've seen the peak of credit card losses, charge-offs? Do you think we've seen the peak of commercial real estate write-downs, mortgage losses?
You know, the most conservative people that I talk to in the industry even admit that they can kind of see the light at the end of the tunnel at this point, that even if we continue to charge off loans, we've identified most of where the problems are coming from. So I have to admit at this point, I think that we're kind of near the peak.
Now, is that reflected appropriately in the valuations for these stocks? Now, granted, there's a lot of variation, but again, speaking in general and particularly about the big banks, the most widely held ones, do you think it's reflected in the valuations?
Absolutely not. I've been doing a lot of work thinking about where valuations should be at this point, and I've been thinking about the financials as really kind of a value to assets play. Unlike a lot of industries, you were talking earlier this morning about Johnson & Johnson having to go and get revenue back. A lot of the service firms are going to have to go get revenue back. These large financial institutions have a book of business already on the balance sheet that's going to drive their revenue going forward. As soon as we get to the point where the charge-offs have abated, these companies are going to have dramatic earnings coming back for them to be able to show the market. That's not yet reflected in these stock prices.
Okay, so what does that mean, though, for the stock prices themselves? Is that to suggest that if we get some disappointing news, call it some higher than expected loss forecasts, it may not depress the stocks much? And if we get some good news, call it, some lower than expected forecasts, or at the very least something that matches your expectations, and those are the more conservative people that you've been speaking to, we might actually see a rally?
I think that's exactly what's the situation we're in. Look at back to the pre-announcements we've seen. First of all, there haven't been a lot at all. And second, you look at the M&Is of the world and had pretty significant pre-announcements that credit wasn't quite where they thought it was going to be. And on that day, the stock was off, I think, 3%. And so I think the market is saying that there's still an expectation of significant capital raises, and that's the key question investors should be asking. To me, the only issue right now to be asking management teams is, are you sufficiently reserved so that you don't have to raise additional equity from here?
All right, we've got four big banks reporting this week: JPMorgan, Bank of America, Goldman Sachs, Citigroup. Would you be inclined to buy on weakness for any of those stocks?
Yeah, you know, JPMorgan's held in very well, but Jamie is the best in the world right now at expense control. And in an environment where I do think still expense management is critical, he's going to beat his competition. Yeah.
Jason, I'm afraid we have to cut it off there. We're coming up onto a break. That's Jason Tyler, Senior Vice President of Portfolio Management at Ariel Investments.